Expectations about future dividend payments by S&P 500 index corporations have been on the move along with equity prices, yet with some key differences. Equity prices have been strongly supported by the Federal Reserve's massive fixed income asset purchases, which have resulted in much lower U.S. long-term bond yields, and that lowers the bar for equities. Arguably, dividend expectations are much less impacted by Fed activity and provide a robust view and a different perspective on how equity market participants are viewing the likely pace of rebuilding the economy. And this will help us explain and understand the apparent disconnect between the V-shaped equity price rebound versus an economy that's not quite as optimistic relative to what's happening on the ground, with many challenges emerging to the reopening and rebuilding effort. Now, dividend expectations are monitored by CME's annual dividend futures contract, and they dropped sharply with equity indexes in late February and March. The recovery in equities has been V-shaped, but there are some interesting differences with dividend expectations. Dividend expectations recovered with equities at first, and then they showed a divergence relative to long-term expectations. That is, while a partial recovery in dividends is now expected over the next few years, as the decade progresses, the dividend expectations have flatlined. As noted, Fed activity explains part of the divergence between the Q2 V-shaped recovery in equities and the more cautious long-term view embedded in dividend expectations. Fed actions lowered short-term rates, lowered long-term rates, and they narrowed corporate credit spreads. All of these Fed actions work to lower the bar for equities and support equities as a search for yield alternative, but these Fed actions are not likely to influence dividend expectations, which really depend on corporate earnings and corporate strategy. Now, corporate adjustments are really what's important here to understand the future of dividends. What we have observed is that the pandemic-induced economic shutdown forces virtually every company to react quickly to changed circumstances. Stressful periods like the pandemic shutdown raise serious challenges and bring out the best in problem solvers. Corporations learned many lessons from the pandemic shutdown crisis, and now they're being applied to long-term strategic adjustments. The lessons from work from home, from supply chain challenges, from the necessity of making quick decisions, and so forth. All of these things may lead to an era of innovation and increased corporate efficiency, which could improve earnings over the long term much faster than revenues. Essentially, many corporations are facing some tremendous headwinds to rebuild their earnings as the reopening of economies goes slower than initially anticipated. Set against the reality of slower reopening prospects are the strategic steps corporations are taking to adapt. Corporations are likely to emerge several years down the road as significantly more efficient, meaning that they will have right-sized their businesses to meet the dampened demand from cautious consumers and yet still have rebuilt their earnings. Dividend expectations are telling us that this path will be difficult, yet as corporations improve their operations, earnings growth may outperform economic growth. I'm Blue Putnam, Chief Economist, CME Group.